Welcome back to the Contrarian, everybody. A lot has happened in the last week with regards to Silvergate Capital and Silicon Valley Bank, both officially having failed at this point as banks. So today I'll be diving into this, as well as how this could tie in with the Fed ultimately being forced to pivot. Myself and a lot of other people, maybe in a similar situation as me, just observing the tightening cycle, how rapid it has been. I'm not surprised at all that something like this has happened. In fact, I would have thought it would have happened a little sooner than it has. But at this point, it just does go to show that tightening this quickly on a very indebted economy, corporations loaded up with debt, it is going to cause things like this to happen at a certain point. So I'm not surprised at all that this did happen. Yeah, apparently the Fed and other Congress members are talking right now with these different groups to see if they can work out some sort of bailout situation. Silicon Valley Bank, the stock has dropped some, I don't know, 80% from its all-time high, but it is surprising that it still has over a $6 billion market cap on a bank that officially has failed at this point. So it does go to show that the stock market might be thinking that there's some sort of bailout around the corner, although if there were to be a bailout, it would be very unlikely that equity holders in the stock would benefit from that. So it is kind of interesting to see that there's still such a valuation being given to a bank that has officially failed. And this has affected financial corporations across the board. Other major banks have also had their valuations plunge in the last week as well, especially Charles Schwab, Citibank, Wells Fargo, banks like this. Just as there's increased maybe skepticism around the whole reserve banking system, how stable really are these banks, even though they're big, even though they might be bailed out, they probably would be bailed out again by the Fed if they were to fail, as they were in the past. But, let's just be skeptical here. So rightly so, there's a lot of questions being raised in the entire financial industry having to do with, how vulnerable are these banks in an environment right now, because we've seen Silicon Valley Bank, we've seen Silvergate Capital. Silvergate Capital's more crypto oriented, so it's definitely not surprising that that failed. But Silicon Valley Bank maybe is being seen as kind of a canary in the coal mine for the financial system as a whole. And unsurprisingly so, Jim Cramer is tweeting that, oh, JP Morgan is a fortress. He also tweeted, tough for a market to handle banks that use Bitcoin and pre-IPO stocks as collateral, but at least there are only two large ones, SI and SIVB. So Jim Cramer has been a great sort of inverse indicator in terms of what is going to happen. So if he's correct again, this would mean that there's going to be a lot more pain ahead for other banks as well, not just Silicon Valley Bank and Silvergate Capital. But why did these two groups go, bankrupt essentially? Why were they unable to return most of their initial clients' money? And a lot of it has to do with how aggressive the Fed has tightened at this point. They've done almost 500 basis points in about a year, which going from 0% to about 5% federal funds rate, that is in a year, that is the most aggressive tightening cycle in modern history to see a central bank do that. This has also obviously tied in with the great rally that the DXY dollar index has had in the last year. It also ties in with how much of a sell-off other treasury bonds have had as well. So there's a lot of ways in which the Fed tightening has sort of played in with this, not to take any responsibility off of these two groups, that they probably were speculating in ways in which was not a risk-averse type of way to invest their clients' money. But there is also a way in which the Fed does play into this in terms of a lot of the, I'm guessing, excess capital that both of these banks had, they were putting into treasuries. Treasuries are seen as just a a way to earn interest on excess cash, and there's supposed to be zero risk there. But as of course, we've seen a massive sell-off in treasuries in the last year. The value of this excess cash has actually been cut very dramatically, and as a result, what initially was a safe place to put their excess cash or capital, that ended up being kind of what made both of these banks fail. So there was a lot of early clients who were able to get their money back, but in terms of actually failing as a bank, Silicon Valley Bank did have that happen just a couple of days ago as I'm recording it over the weekend. So rightly so, there was a lot of maybe scare type mania in the Twitter space and elsewhere going on, saying like, oh, this is the beginning, this is a Lehman moment. That could be true. This could be the beginning of another sort of cascading of events where, next it could be a large bank that ends up failing or coming very close to failing. So it could be kind of a Lehman type moment. Lehman was a much bigger group at the time in 2008. And at the time, it was not seen as we see it now. So it was not seen as, the beginning of the Great Financial Crisis. It was seen as, something bad, but not as bad as we currently see it now. So all that being said, this could be the beginning of a lot of financial institutions going bankrupt and clients being unable to withdraw funds because they aren't there. And just kind of the whole exposing of the fractional reserve banking system right now. That's maybe a worst case scenario, is that it continues to cascade from here. And so the Fed and lawmakers are meeting right now apparently to discuss what to do with the Silicon Valley Bank's collapse that they just had. So I'm guessing that more information about this Fed meeting with SVB and lawmakers, I'm guessing this is going to come out in the next week, so I don't have much that I can talk about with regards to this. There's a lot of ways in which this would impact the tech area, especially startups. There were a lot of startups banking with SVB. So there's a lot of startups that would go bankrupt if SVB were to not be bailed out. Of course, if you do bail out SVB, you kind of have to ask the question, why aren't you bailing out Silvergate Capital or other banks that maybe become insolvent later on? So, of course, there's the moral hazard that you don't want to take on. You do not want to repeat what happened in 2008 where everybody was bailed out, not everybody, but a lot of large banks were bailed out, and then moral hazard just continues to cascade from there. So it would be great if the whole system were to kind of reset right now, even though it would cause a lot of pain, especially if larger banks larger banks fail. They have not yet, but if they do, that would cause a lot of pain. Yeah, so all this being said, this is really what I wanted to touch on mainly right now. Is we really don't have enough to go on yet, in my opinion, to call this a Lehman type moment. This is the beginning of a lot more cascading events occurring after this in the financial institutions. I don't know if that's fair to say yet, but I'm not surprised that two institutions that were very engaged in risk-on assets are finally having issues with how aggressive the tightening and rate hikes have been in the last year. I'm not surprised at all that it's happened. If anything, I was a little skeptical that I was surprised that it took this long. I'll just say that. All that being said, let me know all what you think about this entire topic down in the comment section below. I'd love to hear your thoughts on all of this, and if you like this video, just consider subscribing. I hope to see all of you again at some point.